For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Yeah, that it is. It is Managing Your Financial Future. Johnny Dean, your podcast host. Welcome back. Another episode. This is officially the start of the next season. I don't keep track of season numbers, but we've been off for a couple of weeks, and now we've got the holidays coming up, so the schedule is going to be a little bit messed up, at least until 2026 gets started. But that's okay. We are live. Well, at least we're live to tape. Once again right now, and this is probably December when you're hearing this, if you're listening to this when it comes out. So just a little housekeeping there. We'll be off over the holidays for a week or two, but anyway, you'll still hear episodes. So anyway, I want to welcome back you listeners and my co-host here, Professor Rick Plum, as they make me say, certified financial planner professional and accredited wealth management advisor. How's that? I have not used the card in 8 months. I'm really proud of myself.
Your crib sheet. You finally got it down pat.
I got it down pat. It's really amazing. So I want to talk about Roths today. The Roth IRA, which rears its beautiful head. I love Roths for many reasons, and I know you do too. I can't think of too many downsides of a Roth other than there's no tax deduction going in.
The biggest downside I have is that I don't have enough of it, or I'm not inheriting any of it. That's the downside.
That's kind of an external downside, but a built-in downside. I can't think of too many. So, but here's the thing. You know, Roths were designed, I don't want to say, well, I do want to say this. The Roth IRA was kind of designed with its income limits to allow people with not huge incomes to take advantage of the tax-free nature of the growth inside of a Roth IRA. Now, we also have Roth 401ks. We're going to get into those in just a little bit. But oftentimes people who, as they would say, make too much money feel like they cannot participate in the benefits of a Roth. And Professor Plum, this is true. Okay, so start off, if you would, please. Give us the limits, I guess, for 2025, the limits for contributing to a Roth IRA. I'm talking about the income limits. Because if you make too much money, you can't contribute directly to a Roth IRA. So what are those now?
Well, if you're a single taxpayer and you're adjusted, or actually your modified adjusted gross income, which is similar to your adjusted gross income, but you add back in some other things. But if your income, your total income is too high, and that means if it's over 150, you start losing the ability to contribute directly to a Roth IRA. If you're over 165, you've lost all ability to contribute directly to a Roth IRA. Now, these are contributions, so you're working at any age, you can contribute to a Roth IRA unless your income is over those levels for a single taxpayer. For a married couple filing a joint return, we're talking about, where's my number? I forgot it off the top of my head. 236 to 246. So if you're under 236, no problem contributing to a Roth IRA. If you're over 246, $246,000 of MAGI, modified adjusted gross income, you cannot contribute to a Roth IRA. Mm-hmm. If you're somewhere between those two numbers, you get a partial contribution to a Roth IRA.
Yeah, it's kind of a sliding scale.
This is contribution to a Roth IRA. There's two ways to get money into a Roth account. One is to contribute to it, and that's new money that's never been in a tax-deferred, tax-free status. New money, you're working to support the contribution. I am going to contribute up to $7,000 per person per year into a Roth IRA. If I'm under 50, I can go as high as $8,000 for 2025 if I'm 50 years of age this year or older and working. Got that? And if I don't have to be working if I'm married to somebody who's working.
Yeah, there's spousal.
And you're filing a joint return. Oh, and you say, well, wait a minute. What about those people that file separate returns? You know, do they get the ability to have half the limit, or do they use the single limit, single taxpayer limit? And the answer is no, you get screwed. The phase out is $0 to $10,000.
They don't like that separate thing. I've never found anything.
Well, they don't want people. You've got a spouse that makes $50,000 and a spouse that makes $250,000 together. They can't contribute, and they can't file single because they're married. And so the idea would be, let's file separately, and the one that's making separate money, they're under the single limit. They should be able. Nope. We don't want to split it up like that. We're not gonna do it. Not gonna give you a break.
All right, so there are income limits, but it's odd that there are income limits because if it was designed to keep people from having money inside of a Roth IRA or inside of a Roth tax,
it's designed to keep rich people from having money inside of getting tax-free income.
Aha, but it doesn't really do that necessarily, because we're going to tell you about 4 other ways that
But it was designed to do that, because if you remember, you're old enough to remember, or actually you may have forgotten because you're old enough to forget too. Back when these were created in the late 90s, the one way to get money in is the contribution we were just talking about. The other way to get money into a Roth IRA is to convert traditional IRA money into Roth IRA money. And when we first got the ability to have Roth IRAs, if your adjusted gross income was over $100,000, you were, and that's married filing jointly or single, you were not allowed to convert. So it was not there for people that had, the higher income levels. You just
all right. Well, then
it.
Since you started with that, let's start with that. One of the ways that you can get, and it has changed, as you said, it has changed since 1998 and 99, 2000 when these things were brand new. But one way to get money in, if you make too much to contribute directly to a Roth IRA, is to do Roth conversion. Anyone with retirement assets can convert to a Roth. Earned income is not required to do that. But there are some rules for converting to Roth. Professor, let's go over those very quickly.
Well, I did mention that when it first became available, we had an adjusted gross income limit of $100,000 on our ability to, and that $100,000 did not include the Roth conversion. If you made more than $100,000, you could not do a Roth conversion. But as short-sighted as Congress wants to be, in about 2008, 2009, they realized they needed a new source of revenue. They needed to get some money right now to pass some bills that they wanted. So they said, let's take the cap off the AGI limit for conversions to Roth. So let's do away with that $100,000 limit. We're going to leave the limits on the contributions the same. They do escalate every year with inflation, or potentially every year. They do go up with CPI, but we're going to take off the limit. Now, rich people anybody can convert. And the idea, why did they do that? Was it to help people? No, they wanted to shore up. They wanted to show more revenue on their tax thing so they could pass a bill to spend money. And so they took off the bet. So now, though, anybody can do a Roth conversion. If you have retirement assets in an IRA, you can do a Roth conversion. Traditional IRA to Roth IRA conversion. If you make $10 million a year, Elon Musk, he's got $1 trillion pay package coming out. He could do a Roth conversion, assuming he has IRAs. I don't know if he does. But
he's got to save for retirement one day. It's better put some money aside.
Anybody can do a Roth, and you do not have. This is a very common misconception with retirees when I speak with them. They say, "Well, we can't." We talk about doing Roth conversions into retirement, through retirement, and maybe up until even after required minimum distributions start. They say, well, we can't do conversions because we're not working anymore. No, you cannot convert, or you cannot contribute anymore because you're not working anymore, but you can convert. The only thing you cannot convert is a required minimum distribution. So, but yeah, you can convert. And so having the ability at any income level, now, that doesn't mean at any income level you should convert. Maybe you don't want to pay the taxes because that is a taxable event.
Well, it is a taxable event. Now, we should also mention that a Roth conversion does not have to happen you don't have to sell. If you had a bunch of stocks that are in a Roth IRA, mutual funds, whatever it is, it doesn't have to be sold. Roth conversions can be done in kind, meaning you can move assets directly without selling the investments first.
Right. If you have an asset in a traditional IRA that you don't want to sell, and you don't want to, because there's a ticket charge and you want to buy it back in your Roth IRA, just move it what they call in kind. So I own XYZ stock in my IRA. I tell the brokerage company we're going to open a Roth IRA, and you're going to move, 25 shares or however many shares you want to move from the IRA to the Roth IRA, and they don't sell it and don't rebuy it. They just move it. So Roth conversions can happen at any income level. We don't have to sell it, but it doesn't matter whether it's cash that's going from the traditional IRA, stocks, bonds, widgets, gold. It doesn't matter what it is that's moving from point A to point B. When it leaves point A, the traditional IRA, the value that it is worth on the day that it leaves that traditional IRA is the taxable event on the conversion.
Yes, and this is an important
becomes a convertible event.
And this is an important thing that you just mentioned here, because not everybody, and you just said it a moment ago, not everybody should just willy-nilly convert to a Roth because there are tax consequences for doing so. And there's a cost of admission into the Roth club, and that is the taxes that you have to pay. So it's advisable for you to talk to a financial advisor. Although, Professor Plum, I guess we could do a whole show on Roth conversions, and we have. But just very quickly, from a tax management standpoint, would you suggest that if people have room, especially before RMDs or maybe their Social Security begins, if they have some room in a tax bracket, would you suggest that potentially at least taking a look at doing a Roth conversion and taking it up to the limit of that tax bracket?
Taking it up to the limit of that tax bracket or a potential IRMA limit, because we're looking at different things. Because we will, depending upon where you are, like if you're in the married couple, filing a joint return, you're in the 22% bracket for quite a while. But before you get out of the 22% bracket and then into the 24 at this current age or current rate, you jump into IRMA, and whether or not you're willing to pay that. The problem with IRMA, income-related monthly adjustment amount for Medicare Part B, C, and or D, we don't know the exact number. We know what the number was 2 years ago. We just don't know what the number will be based on this tax return.
Oh,
and
man.
So we can get an idea. We have an idea, but nothing in fact.
Pretty sneaky, sis. So just keep that in mind. A Roth conversion is potentially one way to go. So if you make too much, a Roth conversion, you can get money into a Roth that way. Let's talk about three others here, because we've got a limited amount of time. And as I said, we could do probably entire episodes on each one of these, and have. Another way to get money in is what's called a backdoor Roth IRA, or it's also known as the Roth two-step. Let's spend a moment on that, Professor Plum.
Well, when they took away the limit on the conversions, the AGI limit for conversions, they created a strange area where people who could not contribute because their adjusted gross income was over the threshold, they couldn't contribute directly to a Roth IRA, but they could do conversions to a Roth IRA. So if I am in the right situation, and if I don't have any current traditional IRAs, no SEPs, no Simples, no rollover IRAs, no traditional IRAs in my name, I can open a traditional IRA and contribute my $7,000 or $8,000 to that traditional IRA. Now, people will say, but wait, Professor, there are limits on the IRA as well. And there are income limits on being able to deduct a contribution to a traditional IRA. There is no limit on the ability to contribute to a traditional IRA. Again, Elon Musk, if he doesn't, he could contribute to a traditional IRA, all $7,000. If he can afford it out of his $1 trillion package, I don't know. But he could potentially put $7,000. I don't know. Is he 50 years old?
You know what? I don't know.
He could put money into a traditional IRA. And then, because there's no limit, now he cannot contribute to the Roth IRA because he's over the limit, but he can contribute to a traditional IRA. And then once the money's in the traditional IRA, we can take that money and convert it to a Roth IRA because there's no limit on the converted numbers. So we can take that $7,000 that we put into the traditional IRA and move it directly, 10 minutes later, a day later, and move it over. Now, the key here is, as I mentioned earlier, not having any other IRAs. Because if you have other IRAs, it kind of muddies up the work. Because let's take it from the simple deal that I was with. No other IRAs. I make a contribution to my traditional IRA. and I'm over the limits to be able to deduct it because I have a 401k at work and I'm over the limits. And so I do not deduct the contribution. Therefore, 100% of the money that I just contributed, and since I have no other IRAs, 100% of the money that is in my IRA world is all after-tax money. I've not deducted any of it, so it's all after-tax. And then when I move it to the Roth IRA, it's all after-tax money. There's no taxable event going into the Roth IRA. So in essence, step one was contributing to the traditional IRA. Step two was converting it. After-tax money to the traditional IRA, moving it over to the Roth IRA, and because it's all after-tax, there's no tax event there. I now have my $7,000 or whatever my contribution was in a Roth IRA. Now, it technically is not a contribution, though. It is a converted amount. So it does have a little bit of change of character, and that does affect my ability to withdraw it at any moment because I have now a 5-year penalty rule if I want to withdraw money from that Roth IRA. Because when we're taking money from a Roth IRA, we are allowed to take our contributions out at any time for any reason. No fuss, no muss, no tax, no penalty. Conversions, however, if I withdraw all of my contributions and I start taking converted money out of my Roth IRA, to the extent that that converted money has not been in there for 5 years, 5 tax years, it has a penalty. It won't be taxable because it was after-tax money, but it will incur a penalty. So that's one of the two different 5 or 10% penalty rules for Roth IRAs. But the backdoor Roth is very common. And for a while, when we first started doing these back 2010, 11, 12, 13, we were wondering, is the IRS going to clamp down on this? Is it going to get upset? Is this something that, are we really, they haven't said anything about it. Are they going to make a rule about it? And they did finally came out in 2014, 13, somewhere in there and said, oh, we're going to bless this. You can do this. Not a problem. It's kosher, A1, good to go. So it was nice. They gave us some clarity, which is not their strong point sometimes. So the backdoor Roth really works nicely, assuming you do not have any other traditional IRAs. I know I've said that many times. The reason that could be a potential issue is, let's say I have that $100,000 traditional IRA. Maybe it was a rollover from a 401k. Maybe it's money I contributed over the years on a pre-tax basis, and it's grown to $100,000. But I've got this other $100,000 traditional IRA, and all the money in that is pre-tax money. I haven't paid a dime of tax on any of that. Now I do the after-tax contribution, so my total IRA now is worth $107,000. When I move the $7,000 from the traditional IRA to the Roth IRA, now they're going to look at it and say, okay, 7 out of 107, what's that, about 7%?
A little less than 7.
I should have used better numbers.
7%, yeah.
A little less than 7% of the money that's leaving the traditional IRA is after tax, and the other 93% is taxable because it's a pro rata distribution. And I know somebody will say, well, what if I do it from my 100,000 is in account XYZ, and I create a brand new account, and the only money in that brand new account by itself is that 7,000 of after tax money. IRS doesn't care.
Nope.
All they care about is what's the total IRA value in all of your traditional IRAs, and that's why I said SEP, simple, and rollovers and everything else too. That, and they're going to compare it. It's a pro rata distribution, and it's not a pro rata distribution at the moment of the conversion. It's an annual issue. So be very careful. So what we see a lot of people do, especially if they're still working, and they don't mind giving up the flexibility and the investment options that the IRA offers compared to a 401k, is they take all the pre-tax money in their 401k, or excuse me, they take all the pre-tax money in their IRA, and they move it into their 401k, so that by the end of the year, they have no money in their IRA. It's as simple as that. Now the proration is 100% again. So it's just a matter of understanding the rules, following what we need to do, and using. But I know people that have been doing backdoor Roth IRAs, since they took the limit off, and they've got, even though they make good money and they never could contribute directly to it, they've been doing the Roth two-step for 10, 12, 15 years, whatever it is, and they've got decent amounts of money in their Roth IRAs. They're doing pretty good. So when we're dealing with IRAs, Roth and traditional IRAs. Roth IRAs, you either are contributing to it, you're converting traditional IRA money and paying tax on it, or you're doing a backdoor Roth. That's the only way to get the money into the Roth IRA and from an IRA area.
Yeah, and we've talked about converting here, and so we did that before. Then this particular strategy is the backdoor Roth, which is, again, involves you contribute to a non-deductible traditional IRA, which anybody with earned income can do. You convert that contribution to the Roth IRA. That's the clean version of the backdoor Roth IRA. You mentioned the pro rata rule. You got to be careful of that if you have other, pre-tax, whatever, IRA balances and all that stuff. We didn't really get into, I don't think we got into, rolling the pre-tax IRA balances into the 401k if the plan allows it. I don't.
We haven't talked about 401ks at all yet.
No, and I don't want to get into that, but that's something else you can do if you have existing money in the IRA.
If you have pre-tax money in your 401k, you can roll when you terminate employment, you can roll the pre-tax money from the 401k. Now, we've always had the ability, if we had pre-tax money in a 401k or a qualified retirement plan of any type, if there was some kind of post-tax money and pre-tax money in that retirement account, we could always have them cut us two checks. One check could be rolled over. The pre-tax money could be rolled over to an IRA, and the post-tax money, they could just cut me a check and send me a check for my post-tax amount. And because it's post-tax, there's no penalty, there's no tax, everything works fine. Now, they also clarified that you can take that post-tax money that's being distributed from your qualified plan and go directly to a Roth IRA with it. And it's not part of the proration rule. It's just a matter of all pre-tax goes to traditional IRA, all post-tax can go either to you personally at any age or to your Roth IRA.
So the backdoor Roth IRA is another way to do this. Now, we don't have a ton of time, but the other part of this is a mega backdoor Roth IRA. This is, again, for high income people. Is there a way
before we get to the mega backdoor Roth, we do have Roth 401ks. And Roth 401ks, basically you're doing after-tax contributions to a designated account in the 401k that is after tax and has the same rules basically as a Roth IRA. And when you retire and when you terminate, you roll it from the Roth 401k into the Roth IRA. We are limited by how much money we can put in. Now, the nice thing about the Roth 401k is if you really want the Roth portion of it, there are no income limits. You could be making $500,000, $600,000, $800,000 a year and still contribute to a Roth 401k. But we're still limited to this year, $23,500 with an extra $7,500 catch up if you're 50 and older. But the mega backdoor Roth is the 401k is a form of a defined contribution plan, and the maximum contribution that can go into a defined contribution plan is $70,000, not including the catch up. Unless we have a company that is giving us a really, really nice matching contribution. There is, let's say that they're matching us dollar for dollar. We put in $23,500, they put in $23,500. That's only $47,000. There's still another $23,000 to the limit that we could potentially put in, assuming our income is high enough. What Congress has allowed, and if your plan allows, not every plan does, but if your plan allows, we can go over the $23,500 contribution limit, and we could put in another $30,000 or so, $53,500. And all of that extra contribution is going into the traditional side of the house, the tax-deferred side, not the Roth side, and it's going in after tax. And when these first came out, I thought, well, that's fine, but I don't want to do that for very many years because all the earnings will still be in the traditional side. I'd rather be in a Roth, but I can't figure out how to get there. Now they allow, if the plan also allows, the plan has to be written the right way, when the money goes into the after-tax portion, we can convert that to a Roth right away. So it's kind of like it's like a 401k two-step. We make a after-tax contribution to the 401k over and above the $23,500, and then flip it to the Roth side and let it grow on the Roth side. And we can get quite a bit of money in there, for people. And if I'm not getting a deduction anyway, I sure would like it to be Roth. Because it's after tax either way. Uh-huh. Do I want after tax growing tax deferred and being the earnings taxable in the future? Or do I want after tax growing tax free and the earnings tax free in the future? That's the Roth. I like the tax free.
So how much can we actually put into this roughly?
If your income's good enough, you could put in currently, if you're 50 years of age or older, combined between what you and your employer is matching or putting in, $77,500.
$77,500.
Uh-huh. Because the $7,500 catch-up is on top of the $70,000 limit.
Well, that's right. Yeah, because of the catch-up and all that. Man, oh man!
If you're under 50, it's only 70. Oh darn! Now the biggest problem is how many people can afford to save $70,000.
Well, and that's the other thing, and this is why we're talking about high income. You know, you have to have
this is high income stuff.
Yeah, you have to have a large enough income to really do this, and you know, the whole point of this is to talk about the fact that Roths can be a very good thing once you have the money in there. I mean, I would like every dollar I own to be inside of a Roth, especially things that are growing. But, you know, as I said, the cost to get the money into the Roth can be sometimes prohibitive because these oftentimes it's got to be, well, it's always post-tax money that's going into that. So,
right, so if I have the option between a tax deduction today and tax-free in the future, that takes a little bit of debate back and forth. But once I get past my ability to get a tax deduction, or I don't have the option to do a tax deduction, I'm making after-tax contributions to something. I'm either putting it into my traditional IRA, and it's going to grow tax-deferred, and the earnings will come out taxable as ordinary income. I'm going to put it into my personal brokerage investment account. It's going to grow, and I'm going to pay taxes on any realized gains, either at capital gains or ordinary income, depending upon what's being created in that personal investment account. But the earnings are going to be taxable. Or I can put it into, if to the limits that we can find, a Roth account where I don't worry about taxes evermore. And that is money. That is the best thing going.
Well, it is, and it's also, it can be very good for your heirs because they don't have
what about
tax.
them? It's good for me, darn it.
Well, that's true. That's true. But if you're so inclined, so let me just recap here the 4 ways we've talked about, and we've kind of combined them in different sections. But the ways we talked about to get money in, if you make too much to contribute to a Roth, is the Roth conversion. We started with that. You can do that, and these are all related. The second way was through the backdoor Roth IRA, or what's called the Roth two-step. And then we combined kind of the other two, which was the Roth 401k contribution, if you happen to have that through your employer. Many employers, if not most now, have
Most do now, I think. If you have a 401k, Roth 401ks are very common now.
Yeah, I think you're right about that. And then for the really, really high income earners that have a lot of extra money to potentially put into a Roth, something called the mega backdoor Roth. Now, I realize that a lot of this is details that can be hard to follow, and you know, we're throwing around a lot of terms here like IRMA and things like that. But what's the important thing is that there are ways to get money into a Roth. Now, very quickly, Professor, you just mentioned something a moment ago where you said that the real decision, and this is true, is to Roth or not to Roth. As good as the Roth can be, the fact is you got to put post-tax money in. You know, this, if you had to sum up somebody's decision as to whether or not they should put in Roth money now or take a tax deduction now, how would you describe that? What's the very quick process you go through when trying to decide whether to do pre-tax or do Roth?
Gain versus cost. What is it costing me today to get the gain? So if I'm doing a traditional 401k, I'm getting a tax benefit. What is that benefit? And then if I'm doing a Roth IRA, I'm getting tax-free in the future. Which benefit is bigger? Which one has a better bang for the buck? And it is not always the younger you are, the better you are for a Roth, although it tends to be. And the older you are, the worse it is, but that's not always the case. It's just a matter of, what am I getting? I was speaking with somebody the other day. They're a little later in life getting started on things. They're not super high wage earner, but they're probably in the 22%. I know they're in the 22% bracket right now. Single taxpayer, but they only have $150,000 in their IRA at this moment. Traditional IRA 401k combination. They are contributing and they are building it, and we're looking at them retiring at age 70 because they're 63 now, and so we're looking at the balance. Could be about $400,000, $350,000 when they retire. Now, if I have a $350,000 balance Now they're going to have Social Security, their house is going to be paid off, and they don't need $50,000 a month to live. But what's the distribution from $1,000 a year going to look like? $15,000 a year, something of that nature. You take $15,000 a year plus their Social Security and work through the code, and they're going to owe almost nothing in income taxes. It's basically tax free when they start retiring. The Roth IRA would be tax free, but they don't get the deduction today. The traditional IRA is still going to be tax free because their incomes aren't going to rise to the level of taxation, but they get the tax deduction today. In that case, even though they're not in a super high tax bracket, the deduction today is better than the tax free in the future, which I get either way.
So that's
but I've
really
also
the
met
decision.
some 40-year-olds. I've also met some 40-year-olds who have been saving and building and investing very well in their 401ks, who've already got 7 figures in their traditional IRAs, and even though they're still in a high tax bracket, the deduction today they need to do. They're going to do Roth going forward, because they're going to give up the tax deduction today to have the tax free in the future, because they're going to be in a very high tax bracket when they ultimately have to start taking money out.
Yeah, so the normal way to look at it is a tax bracket today versus tax bracket when you take it out. Ideally, if you're in a high tax bracket today, take the deduction. Ideally, if you're in a lower tax bracket but expect to be in a higher one when you take it out, do the Roth. But obviously,
I'd say equal to or greater, go the Roth.
That's true. Well, this has been a lot of information here. The main point is that if you make a lot of money, you can still, there are several different ways for you to get money into a Roth. And I would posit that if you make a lot of money now, you're probably going to be in a somewhat high tax bracket when you retire, and especially when you get to required minimum distribution age and all that stuff. So having money inside of a Roth really couldn't hurt you too much, especially from an RMD standpoint.
I mean, if the worst case is you gave up a little tax deduction and you got too much money in Roth, okay, there are worse things in life than having too much Roth money. I mean, hey, life is just now, I mean, if you're going to make an error, I would err towards the Roth, but it's what it is.
Yeah, it is. It's like saying, I one day I'd love to pay an estate tax. That's because that means I've got a ton of money.
I live in California. I'd like to be in the California 13.3% income tax bracket. My annual income is not $1.5 million. I darn it.
But you
I would
it.
complain. I would take the income and complain about the taxes I'm paying, and I would complain all the way to the bank.
If you want some more information on this stuff, and as I said, I realize there's a lot of information here today, certainly talk to any of the Lucia Capital Group advisors, 800-644-1150. That's the number there at Lucia Capital Group, 800-644-1150. You should know that by now. Professor Rick Plum and any of the Lucia Capital Group advisors do this all the time. I would say probably every single day somebody is working on this decision for somebody and talking about getting money into the Roth. 800-644-1150. Also find information online, luciacap.com, luciacap.com. And you can also download our guides. I mention this all the time. Type in the search bar in the upper right what you'd like to download, bucket strategy, tax management, estate planning, Social Security, all that stuff. Type it in. You could download it for free. Subscribe to this here podcast. It is called Managing Your Financial Future. Very clever title, I know. But you can subscribe to that and listen every single week. We're slowly approaching episode 250. Can you believe that?
We're getting there. We're getting there.
We are. I remember when we were hitting episode 200, how excited we were. But this is a lot of good information out there. And make sure you subscribe to this podcast and listen to every single episode. Professor Plum, thank you so much. I know I'd like to give you a chance to share your knowledge or show off or whatever it is, but I think you really did that today.
Thank you.
Thank you. All right. For Professor Rick Plum, certified financial planner, professional, accredited wealth management advisor. I'm your podcast host, Johnny Dean, managing your financial future. Thanks for listening. Talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59 and a half may also be subject to a 10% penalty tax. The Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59 and a half or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Distributions of principal from a Roth 401k are tax-free. Any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59 and a half or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with the Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options. 1. Leave the money in their former employer's plan if permitted. 2. Roll over the assets to their new employer's plan if one is available and rollovers are permitted. 3. Roll over to an IRA. Or 4. Cash out the account value. Stock investing includes risks including fluctuating prices and loss of principal. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at www.ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Any other individual or company mentioned in this podcast are not affiliated with or endorsed by Lucia Capital Group or LPL Financial.